Thank you, Spencer. And I want to say how really delighted I am to be joining my first ICMA annual conference. And like the central bank governor said, that was such a great start. And I hope we can get copies of the video, or you'll post it, because it took me back memory lane in many ways. Spencer asked me to set the tone for our panel, and I'm sure you're wondering, why do I have a title, Defeating the 10-Headed Hydra? Before I get to that point, I do want to start with what is usually my day job and the day job of my colleagues, which is focusing on the global goals. And I'd love to have someone turn the slides. Where is it? Oh. Okay, so I need to. Okay. Many of you know that last year was a defining year for development, because global leaders basically agreed to tackle some of the world's most difficult challenges, whether it be in development, in respect of climate change. And they agreed to set up 17 goals with very specific targets so that by 2030, we can all look back and say, this is the progress that the world has made on this issue. And these goals, as you know, ranged from ending poverty, addressing gender issues, climate change issues, fueling innovation, investing in infrastructure, creating jobs, and fueling and enabling economic growth. I do believe that we must tackle these challenges with a sense of urgency. And I just want to share some data with you. As we're all here today, there are 800 million people in the world who have no access to clean water. There are about 1 billion people who have no access to energy. Another 1 billion who have no access, or who are about 2 kilometers away from a road that is usable. We have about over 2 billion people who have no access to sanitation. And I can go on and on. And I know that everyone in this room cares. But I also want to say that probably why we've dealt with a global environment that has been struggling for the last 8 years is really because we haven't focused collectively on tackling what I consider the global challenges. I also want to suggest to you that it's not just caring of the rest of the world to focus on the global challenges, but it also makes good business sense. Because some of what we're dealing with on a day-to-day basis in our business, whether it's the geopolitical uncertainty, nationalistic tendencies, security concerns, constrained government budgets, ballooning debt, falling commodity prices, a low risk tolerance, conventional monetary policies, challenging regulatory environment, as well as a low yield environment. All of that, if it was different, we would have a more prosperous world. So let me just take 3 of the last 10 that I just talked about. I think, Spencer, you had talked about the regulatory environment in your opening remarks. I know the banks feel it. Some banks tell me they're having to exit businesses, refocus, because of the capital charges that regulators are now asking them to put aside if they want to remain in certain businesses. We're feeling it, even as the World Bank, a AAA-rated institution, because repo markets are disappearing, because swap spreads are widening. We're seeing that ourselves, the US government, sometimes we're issuing at levels that we weren't used to issuing in the past. Everyone thought that, of course, the expansionary monetary policies, the unconventional monetary policies, can be a source of help. Maybe they're a source of help. Maybe things would have been worse without the unconventional monetary policies. But the 5 big central banks in the world together have expanded their balance sheet by $8 trillion. That's half of the United States, or a little under half of the United States GDP. And people wonder whether much has happened, because of course there's no more you need to do than use monetary policy to tackle the challenges that the world faces. We're having more volatility, but I think even more important is that we're having very low yields, and of course in Europe and in Japan and in some other countries, negative yields. The central bank governor shared with us how vibrant an asset management industry you have in Ireland. I was shocked when my colleagues shared the statistics with me on how much money that is being managed in the world. It's $163 trillion, according to Citi UK. So that's 9 times the GDP of the United States. And I wouldn't tell you how many times the GDP of the African continent, which is, I think, $2.5 trillion in total. And even if asset managers set aside 1% of the $163 trillion, it will be $1.6 trillion, which means that all of it can fund the infrastructure gap in all of the emerging and developing countries on an annual basis. But of course, some of it is comfort with risk. And one of my key messages is that collective effort will mean that we can make progress on the global goals. But it is a shared interest. It is not altruistic, and it also makes good business sense. Just before our panel, just before the event started, Spencer was chatting with us panelists, and we're talking about what is it that it would take to make some of the key initiatives happen, like the European Fund for Strategic Investments. And my response is that it's a true partnership where everyone brings the best of themselves. And if I take multilateral agencies like the World Bank as the example of public sector, some of what we hear, for example, in infrastructure, is that there is not a pipeline of bankable or investable projects. And we've taken that on board. Joachim, who's here, as Spencer mentioned, the MD CFO, has taken that as something that we should focus on as an institution, to create that pipeline, to ensure that there's appropriate regulation, to provide you the gamut of instruments that we have, either from our guarantee agency, from the private sector entity, IFC, or from the World Bank itself, to give you that comfort to invest in infrastructure or in other types of things that we do. Provide you that guidance in terms of environmental, social, and governance standards. Strengthen the public-private partnership framework. Provide you advisory services. Be there as an honest broker on both sides, both for the governments, but also for the private sector. The Minister of Finance mentioned the importance of capital markets. We do believe at the World Bank that it's very important that domestic capital markets continue to flourish. We think it's our day job to focus on it, but we think that the private sector also has an important role to play. You can create markets, you can structure solutions, you can structure new types of products or products that focus on risk management. We ourselves, of course, have the Global Infrastructure Facility, which a number of you or your organizations are partners of us with. There are other initiatives. Spencer promised me that we'll talk about the European Fund for Strategic Investments and get views on how it's going. But I will start off by saying that I think that if between the European Commission and EIB, that they've put aside a plan for $21 billion of funding, which could basically be leveraged 15 times, it can do a lot. It's a good starting point. I think the question is whether we have the things that we need to have to develop the pipeline and to implement the projects, and whether we have the kinds of projects that you would like. But I like very much the vision around the One Belt, One Road initiative that President Xi Jinping has talked about. It will cut across 65 countries, and it will affect 4.1 billion people. And I am absolutely certain that the catalytic role will be enormous. What am I saying? I'm saying that we can turn what I consider a multi-headed hydra, and I think it's a 10-headed hydra. Some people actually think, some of my colleagues think it's 15, some think it's 5, into an opportunity. But we can also focus on doing well and doing good at the same time. Let me end with an Irish poet's poem, which I like very much, for many reasons, but a number of you may be familiar with Chinua Achebe's works, one of the prolific African writers. And that work was titled Things Fall Apart, and it was basically inspired by W.B. Yeats' The Second Coming. That poem reads, as you can read, turning and turning in the widening gyre. The falcon cannot hear the falconer. Things fall apart. The center cannot hold. Mere anarchy is loosed upon the world. I would like to attempt an interpretation. Turning and turning in the widening gyre. Volatility and volatility in an increasingly fragile economy, global economy. The falcon cannot hear the falconer. All stakeholders, governments, regulators, banks, other market participants may not be hearing each other. Things fall apart. The center cannot hold. Swap spreads, repo markets shrinking, markets disappearing. The center may not be holding. Mere anarchy is loosed upon the world. I am not planning to interpret this one, because I believe that the 10-headed hydra, the global goals, can be tackled successfully if we act collectively. And I do believe that this conference this year is very defining, because over the next 2 days, given the quality of the conversations that I know we'll be having, I'm absolutely certain that we will tackle these issues in innovative ways, so that, in essence, we create opportunities for ourselves rather than have the 10-headed hydra continue, and that collectively we can defeat the 10-headed hydra, but also succeed with the global goals. Thank you.
Thank you. Well, I'm going to have to say wow for the second time. The first was after that video, and now it's to have to moderate a panel after that fantastic introduction. We are a little bit short of time, so I'm not going to introduce the panel per se, except I think you can read their bios. It's a great panel in the brochure. I'm just going to pick up on a couple of concepts that Arunma has touched upon, because it is the panel is about the global capital markets, and I think, you know, liquidity, regulation, the volatility, these are all kind of main themes. I want to hit upon those, but I do want to end up on some positive notes, because there are some really positive things going on in the world. And then I'm going to be a little bit provocative with Arunma when she talks about collaboration, because I have views on some of these things, and that's why we had the conversation before. But let me start it off, because we've seen more volatility be introduced recently because of ECB actions and their recent introduction in March of a corporate buyback scheme. And I'm curious to get from, you know, maybe from Marc and Frank and other panelists as they see fit, you know, what does that mean to you? Is it a form of competition from the primary market? Has it been appropriately done? What are your views?
Okay, thank you. I'll give it a go. So clearly, it is an event that has already impacted the market, even though the ECB hasn't formally started purchasing yet, and it's something that will undoubtedly have an impact and continue to have an impact on the way corporate spreads and corporate bonds are behaving. I think it's pretty clear that it will further weigh on liquidity, because the metrics have now been defined. And it is expected that even though the ECB can buy up to 70% of a single transaction, the expectation is that they will likely end up being holders of somewhere between 20 and possibly as high as 30% of single transactions. And those transactions were already not benefiting from the greatest possible liquidity in the secondary market. So if you add a price-insensitive buyer into the mix that will hold such a large proportion of transactions, we think that it will further weigh on secondary market liquidity, including the fact that it will be very dangerous for traders to go short of any particular transaction. So maybe as an opening comment, undoubtedly, Frank, you'll want to add.
Yeah, I think looking at it from the buy side, it's clearly a major disadvantage that the central bank, especially the ECB, is creating with these type of purchasing programs, because it will tremendously reduce the free float of bonds out there, and so secondary market liquidity will almost as much disappear as it already has on covered bonds in the Eurozone or in Europe more generally, and in the ABS space, where the ECB has been purchasing these type of assets for many years now. And that obviously makes investors looking at alternatives. And so clearly, basically, the end investor, given the fact that yields will be getting compressed further and further, the overall yield level will, you know, turn lower and lower for longer. Investors will look for higher yielding alternatives. Now, that might be a good thing. That's a typical portfolio balance effect that the ECB is aiming at. But obviously, it means that risks are being transferred to investors, to end investors, and ultimately to taxpayers, that these taxpayers in the first place might not have been willing to take. So clearly there's an issue out there that has to do with consumer protection, and so I'm not sure that the type of central bank actions we're seeing are good neither for market structure, market infrastructure, nor for the ultimate end investors, you know, investment rationale that put them out there in the market in the first place. So clearly, I do think it's a good example. It's a very good example. And just take this. I mean, recently been to the Bundesbank. They don't have a risk assessment team for corporate debt. They don't have it. The ECB doesn't have it either. So how do they gonna conduct operations in this market? We will all know soon, but it's definitely a risk. There's a big animal in the room that doesn't have a clue about this market. So clearly, you know, is that something monetary policy should do? No, not necessarily. Is this a good example for the end of the effectiveness of monetary policy? Yes.
I think it's a good question. I mean, this inflection point between monetary policy and market practice, if you will, is quite an important one. You touched on it, Arunma, but maybe Jean-Michel, I think at S&P, you guys would have a view on this, because your job is to assess risk, if you will, where are we taking ourselves from your view with such activity?
Well, clearly, hello everyone. Clearly, we are in uncharted territories. But that's a cliche, but that's very true. Let me take just a hindsight for 1 second to say that, you know, right from the beginning of this global financial crisis around 2008, central banks, starting with the Bank of England and then the US Fed, ventured into unconventional measures based on the experience and the knowledge of those that were running those central banks at the time and were generally with an academic background and had studied in great details the 1929 response to the Great Depression. And at the time, as you remember, central banks, you know, in hindsight, clearly contributed to making that 1929 crisis even worse. So the view was very early on to take a very proactive stance, by contrast with the 30s, and explore, including exploring avenues that had not been explored before. And all this was famously summarized later on by the "whatever it takes" line from Mr. Draghi. Now, of course, those measures are distorting the markets, clearly. Today, we have about, on a global level, we have about close to $9 trillion of bonds, including 900 billion of corporate bonds that are trading with negative yields. That's out of a total universe of about $56 trillion. We've never seen that before. And clearly, we have, with these new measures that we're just discussing, it's going to be even bigger. That's precisely the intention of the bank, of the ECB in that case, is really to push investors towards higher risk segments, speculative grade, in order to contribute to restoring risk appetite and stimulating the recovery. Now, at the same time, clearly, the attitude of the investment community, I was speaking at an insurance conference 2 days ago, and you can imagine, you know, the current climate in the insurance industry when you have such yields, you know, and what do you do? Where do you put your money when you have a mandate to invest only in investment grade, for instance, instruments? So I think this is going to carry on. In fact, I would expect that by the end of the year, we're going to see more negative rates being implemented by the ECB on excess deposits, because those policies, the QE and non-conventional policies, will take a long time to produce the desired effects. So don't expect this to be, including the corporate bond program, this is not a temporary thing, a temporary attempt. This is going to be pursued over several years, in my opinion, at least until 2018.
I mean, the challenge, obviously, as a banker, we have a couple of bankers on the panel. Maybe Yu-Sun can give us his view, and I'd love to hear Arunma's view. But if you look at the intention of moving people to higher yielding assets suggests that banks also move towards, sub-investment grade lending on their balance sheet. When you look at the risk-weighted asset charge, the capital requirements for that, actually that doesn't work either. So you end up having a huge amount of money following effectively the same high investment grade product, and the low sub-investment grade space gets penalized. But, from a banker's perspective, how does this affect you? You run the bank's balance sheet of the Bank of China in the UK, which is quite significant. How do you look at it relative to kind of...
I would say it's a challenge for all the investors. Investors are hungry for assets with positive yield. For Bank of China, I think the only way out is to expand the investment of the balance sheet to some new projects, like what the One Belt, One Road initiative could bring us. Of course, I think talking about that strategy, I think risk is definitely the concern of all the market participants. But I think it requires expertise and diversity, which means, you must have the skills and the procedures to understand the risk And meanwhile, you need diversified financial institutions to participate in the whole process. That's why we have AIIB. That's why we have development banks. That's why we have the commercial banks. So I think based on that kind of strategy, we can more diversify our balance sheets, can generate relatively satisfactory yield. So that's one of the potential solutions. Of course, if you put it in a broader scope, I think the openness of the onshore RMB market is another opportunity for investors. I'm not asking you to do the investment blindly, but I'm asking you to better understand the market there, because RMB bond onshore is still offering quite high yield. Even the Treasury offering above 3% or 4% yield.
I just want to add one quick thing, which I don't want to be a total contrarian. But if you, as a very large investor, since the beginning of the year, were only invested in the shortest dated German bunds, or rather the Schatz and the Bobbles, you would have had a positive return of 1.4%. So in other words, I think we're all saying that the ECB wants this transfer to riskier assets and to sub-investment grade and whatever else. There is a reason why some of the larger investors are all complaining but may not have made that move yet, because by simply staying in short German government bonds, you would have had a pretty good positive return.
And that is the reflection of these, 10 hybrids that you were referring to in your opening statements, because it's obviously uncertainty that is creating, and my belief is the low interest environment is partially responsible for this type of uncertainty and sort of wait-and-see behavior, specifically by real corporate investors. Because let's face it, let's just take one step back in economic history or going to the textbooks. Low interest rates mean either no inflation or no growth. So there's trouble out there in the global economy, and that, why would you invest in CapEx and others? So, clearly, and there's an increasing strand of academic literature, including econometrics, who are trying to find out whether the low yield environment or even negative yield environment that we're in is partially responsible for the subpar growth that we see globally, specifically in those countries who have emerged relatively well from the financial crisis. So, just to give it a thought.
We manage about $150 billion of our own liquidity, but also of some of our clients. And in addition to what's been said, for some of our strategies, we depend very much on the health of banks. And so what you're seeing is that with the negative interest rates, banks are obviously not having their depositors pay them money to keep their deposits. So they're shrinking margins. And what we're worrying about is the health of banks and that the number of counterparties that we have to deal with for a number of our strategies are also shrinking. We see, of course, the same thing that happened with the bonds, with the JGBs and some others. But what I think will happen ultimately is that people will start to look at other assets. When you look at some of the data, and see that people are focusing much more on U.S. corporates than happened in the past. The data I remember is $5.2 trillion of funding in U.S. corporates. I think that's coming from the negative yield environment. So maybe, if you do this long enough, if you drag us along enough, we will all, move to the riskier assets.
Well, let's see. Let's see if it works, because again, at our bank, it's not obvious that we're going to redeploy large amounts of money into high risk-weighted assets. In Belt and Road, I get it. It's one of our collective favorite topics, and we'll talk about it in a second. But it's still not going to be the epiphanal change, because the risk of that is quite high. But maybe Jean-Michel, I just want to switch it very quickly, because we still have a lot of regulatory change that needs to be implemented. That's been on the drafting board for a while, whether it's MAR, whether it's MiFID II, et cetera. And when you look at your risk assessment, as you just alluded to, because of the illiquidity, how do you factor in still untested, compliance-related issues? And then secondarily, how do you look at fintech coming into that space? Is that going to be additive or subtractive? Because as Arunma said, the pressure on banks at the moment to deal with all of this stuff is quite intense. and yet we still have a lot of milestones that have yet to be introduced?
Well, my answer to that will be extremely short and as clear as possible. There has been, from the beginning, again, of this period, starting in 2008, there's been some conflicting trends between monetary policies in the developed markets and regulatory trends and changes. And they've gone in sort of opposite directions. Again, on one side, having very strong incentive being provided to the banks and investors in general to take more risk and venture into less familiar territories. And on the other side, a strong regulatory message, that is to say, if you do so, you better do it right, because otherwise it's going to cost you a lot. And of course, this is, now we are told that there will not be any Basel IV to be seen, but certainly we're not at the end of this, and I don't detect any although there's been clear messages coming from the Bank of England, coming from the ECB, saying, to the regulators, saying, look, we've got to play ball together. I mean, we cannot have our own things separately. Still, I see conflicting trends here, sort of reducing the overall efficiency of both regulation and monetary policies.
Okay. We're eating into your coffee time. I'm very sensitive to that because I feel like a coffee myself. But before we do that, I want to get back to this point of collaboration. So it's a deviation from market liquidity and regulatory impact of further market illiquidity. But you mentioned the kind of collaborative impact that's required of everybody to deal with, the sustainable agenda, the infrastructure agenda, and we connect infrastructure, green, and China very closely together. It is that triangulation which is, I think, quite important for all of us to recognize. But one observation I would make, and I was in Washington at the spring meetings and heard Jim Kim get up there with 10 MDBs talking about collaboration. My personal view is that it's an often overused terminology, because in fact all the MDBs, who are quite important in the capital stack or the reinvigoration possibility to get infrastructure on track, in addition to pipeline, et cetera, is the fact that they all do their own thing. And that there's very little commonality except for AAA ratings across the MDBs. That actually what would be quite fruitful is to come up with a very common set of products around the biggest issues, which are credit enhancement and risk mitigation, and scale them up to be of global proportion so that they can actually address the issue on a global basis. I'd love to get people's views on that, if that's a meaningful concept, if it's doable.
Do you want me to react?
Yeah.
First, we agree with you that we need to do much better than we've been doing in the past. And indeed, at the spring meetings, all of the heads of MDBs essentially got together, in my view, for the first time in a public panel on infrastructure, talking about what the issues are and how they can collaborate. But we're doing it in very, very specific terms. So the World Bank group annually does about $50 billion in lending, and let's say that's probably about half of it in infrastructure, probably. People have asked why we've been very supportive and excited about the Asian Infrastructure Investment Bank coming on board, and why we're looking at co-financing options, where we're looking at supporting them in certain areas to scale up. It's that even if you put together what all of the MDBs do, maybe collectively $100 billion a year, and that's in everything. And if the data I have is right, that you need $1.5 trillion every year for infrastructure alone in emerging and developed economies, we have no choice but to work together. And anyway, you're not going to take all the risk alone. You need to risk share, so you need others to come to the party. We believe that there are strengths of each one of us. So for example, for safeguards, for environmental issues, social issues, and governance standards, which tend to be very, very labor intensive. The World Bank has a track record of 70 years. And in a partnership with an AIB, it's very unlikely that they can build that track record immediately. So if we get involved together in a transaction, it will certainly make a difference. What we're hoping is that together with MDBs, that we can attract many of you who represent institutions that can be involved in this, because I do think that the point about being an honest broker is a very, very important one, because sometimes you're not quite sure how to deal with governments. In terms of regulation, you're not sure whether you have sufficient leverage. But if we're in a deal together, we can essentially do more and do better. One of the deals I like very much that we've done in the past is some support that we gave to the Sao Paulo city, where we ourselves, and this is even within the World Bank Group, leveraged the IBRD's experience with the labor-intensive aspects of the business, brought in our guarantee agency, MEGA, which provided the cover that allowed some of the private sector banks to be involved in the deal. So there are examples. We just need to do much more of it.
Frank, do you guys invest? I mean, is infrastructure an asset class for you that if the World Bank and others came in, does it make it?
Yes, I think the bottleneck is not necessarily the interaction of the private sector with the MDBs or the MDBs as such in terms of the collaboration. I do think the bottleneck is the policymakers, so the governments. Give you an example. If you want to do glass fiber investments in, continental Europe, you have to face each and every municipality separately. And if they don't want to do risk sharing or sort of PPP partnerships to do these type of investments, which are very long-term, very expensive, and where lots of capital would be available, private sector capital, to sort of burden share, risk share that, then it won't happen. So clearly there must be a change, in my view, specifically in the sort of government space, be it in municipalities, in states, at the federal country level, to engage in public-private partnerships and the likes, to sort of get that process running. Because quite honestly, there is massive interest in infrastructure investments in the private sector. There's plenty of capital and assets around, or let's say liquidity around, but there are not enough objects, there are not enough viable projects that could deliver returns and deliver scale sufficiently to meet that demand for infrastructure investment. So clearly it's a supply constraint, and if you can intermediate that supply constraint, that would be brilliant, but I do think we need to start with the government officials actually.
No, I think it's an interesting point, because obviously in these less liquid, very, very low yielding, negative rate environments, you would have thought that the money is there to deploy, but yet actually the interaction is low. And, we do see this crowding out feature continue to happen because also the MDBs are looking, aggressively to expand their balance sheets to help with the cause, which is good, but actually the effect of that and crowding out is kind of a negative effect. That's a different topic. I think we don't necessarily have time to go into, because I think it's a big one.
I was just going to say that there are a few things that we're doing, because whether it's pension funds or insurance, they're used to investing in a certain way. So most of us invest versus a benchmark. So one of the initiatives Joachim has been leading since he joined was to have us work with providers who can develop an infrastructure index. And what we can do is have some of our transactions that we've already been involved in become part of those indices, and then we can focus on more greenfield projects. So there is a lot that can be done. And I do agree with the point about policy, but I think that that's the leverage that we have with individual countries. And we do exercise that leverage. And countries are also looking forward to getting support in understanding better. We've supported a number of countries with setting up PPPs arrangements within their ministries of finance as part of trying to make progress in this. But maybe there needs to be a much greater sense of urgency.
Yeah. Just one last question. I want to pick up on Yusun's point about the Belt and Road and RMB internationalization as being a catalyst. Again, thinking of higher investment opportunities to offset these low yields, the liquid product. What should people take away from the Belt and Road? I mean, as China globalizing, what does that mean for this audience and for this market environment?
I think, China is already the second largest world economy, which contributed more than 13% of the world GDP. But for any global fixed income investor, I think you are still seriously underweighting RMB assets. I think it's because RMB is not yet, the capital account is not open yet, and before the onshore bond market is not open. But I noticed that from beginning of this year, it's one of the key targets for Chinese government to open its capital market. China already have the second largest equity market in the world and the third largest bond market, which is going to be the second largest one, I guess, maybe by the end of this year. It's growing very fast. So I think, what I just want to remind you is not to just do the investment, but to start to do the study of the Chinese onshore bond market. The access is getting much easier for any global investors. And I think, the total outstanding is already $5 trillion pounds. So it's already huge enough. But, of course, it can be very risky. But I think, based on very good study and based on very good outstanding, I'm quite sure you can find good relative value by doing investment in onshore RMB market. So I think for any global bond investors, it's a risk if you 100% ignore the RMB bond market. So that's my advice. Yeah. But of course, it must be based on very good understanding, very careful study of the Chinese economy.
I mean, to give a sense of scale, the Chinese economy is around a $10–11 trillion economy versus the United States, which is the largest at $17–18 trillion. If you look at portfolio flows, inbound, outbound in China as a percentage of GDP, they're in the kind of 2 to 3%. When you look at any kind of emerging economy, it's in the 25 to 30%. And when you look at a westernized economy, it's in the 50% range. So you have the second largest economy where portfolio flows, inbound, outbound portfolio, are 2–3% of GDP. And I think your point is the right one. If we're looking for kind of positives in this world of kind of difficult situations, there's a tremendous opportunity. Actually, in the inbound ability is open architecture. You and I talk about it a lot. The architecture is open. The outbound is more complicated, but it's the inbound that is actually probably the most interesting.
So Spencer, would it help that in October the renminbi will become part of the SDR?
I think it's going to help. I don't know if it's going to be an epiphanal move. It'll be 12% of the SDR when it becomes a full-time member, if you will. But I suspect it's not going to be a catalyst, for revaluation or valuation in changes or
But there are a number of central banks that have reserves in SDR
already.
They'd have to rebalance.
Yes.
A number of other international organizations. Yeah.
SDR is a kind of milestone event for RMB to become more internationalized. But more meaningful event is that some investment index, for example, like the Morgan Stanley Com Index, they are talking about to include A share or maybe onshore bond market into that index.
Which is a July kind of
Yeah, it's
event.
possible. Which means most of the passive investors, they must follow the index, which will create more inflow into the RMB bond market. So I think that's even more meaningful in terms of asset allocation. So
we are woefully out of time. What we were trying to do, hopefully we did. I mean, there are clearly some negatives out there which we are unable to overnight influence. We can collectively work with regulators and policymakers to affect it, but it's hard to do it overnight. At the same time, there are some unbelievable investment opportunities that are out there, and the emergence of these big economies and these big asset classes, whether it's green or infrastructure, which is related, or China, I think is unbelievable. So I think that all of us should think about that and kind of try to offset that negative with the positive if we can and move forward accordingly. But let's a round of applause to thank the panel for their time, and let's get some